Blockchain technology is an innovative form of a digital ledger used to record transactions across a decentralized network of computers. This ledger is secure, transparent, and immutable, which means once data has been added to the blockchain, it cannot be altered or deleted, ensuring the integrity of the record-keeping process. The term blockchain originates from the way the technology works. Data is grouped together in blocks, and each block is connected to the previous one, forming a chain. This structure ensures that each subsequent block reinforces the verification of the previous block and hence the entire blockchain. This makes the blockchain secure by design. Blockchain technology emerged to enable secure, peer-to-peer transactions without the need for a central authority, like a bank or government, to validate the transactions. This decentralization is considered revolutionary in that it reduces the potential for fraud and corruption while increasing transparency and trust among users. When a transaction occurs, it must be verified by the network. This is usually done through a consensus mechanism, such as proof of work or proof of stake. These mechanisms help to validate transactions and add them to the blockchain in a way that ensures all copies of the distributed ledger are the same. Once a transaction is verified, it is combined with other transactions to create a new block of data for the ledger. This new block is then added to the existing blockchain, in a way that is permanent and unchangeable. Thus, the integrity of the entire chain is maintained. The features and benefits of blockchain technology include 1. Decentralization. Unlike traditional ledgers or databases that are controlled by a single entity, a blockchain is decentralized and distributed across multiple nodes or computers. This means no single party has control over the entire network, making it more resistant to malicious attacks and fraud. 2. Transparency. All transactions recorded on a blockchain are visible to all participants and cannot be altered once they have been confirmed by the network. This transparency helps to build trust among participants. 3. Security. Blockchain uses advanced cryptographic techniques to secure data. Once a transaction is recorded, its authenticity must be verified by the network before it is added to a block. Furthermore, each block is linked to the previous one, creating a secure chain of transactions. 4. Immutability. Once data has been recorded on a blockchain, it cannot be altered or deleted. This immutability ensures the integrity of the transaction history. Blockchain technology has potential applications far beyond just managing digital currencies. Its features make it suitable for a variety of uses, including supply chain management, recording the production, shipment, and receipt of products in a supply chain on a blockchain provides transparency and reduces the risks of counterfeiting and fraud. Healthcare. Securely storing patient records on a blockchain can improve data accuracy, enhance the security of sensitive information, and provide a clear history of patient consent. Voting systems. Blockchain can provide a secure and transparent framework for electronic voting, reducing the potential for fraud and ensuring the integrity of the electoral process. Identity verification. Blockchain can offer a secure and unforgeable way of managing digital identities, reducing identity theft and improving online security. Despite its potential, blockchain technology faces several challenges, including scalability, energy consumption, and regulatory issues. Scalability is a significant concern, as current blockchain networks can only handle a limited number of transactions per second. Energy consumption is also a concern, especially for blockchains that use energy-intensive consensus mechanisms. However, continuous research and development are addressing these challenges, and new advancements are being made to make blockchain more efficient, scalable, and accessible. As the technology matures, it could lead to widespread changes in how we conduct transactions and manage data across various sectors. In summary, blockchain technology offers a new and innovative way to record and secure digital transactions. Its decentralized, transparent, and immutable nature has the potential to revolutionize various industries, making processes more efficient, secure, and transparent. Despite facing challenges, the future of blockchain looks promising as it continues to evolve and find new applications beyond just digital currencies. Bitcoin is a digital currency, also known as a cryptocurrency, which operates on a decentralized network of computers. It was introduced in 2009 by an anonymous entity or group known as Satoshi Nakamoto. Unlike traditional currencies issued by governments, fiat currencies, Bitcoin offers a peer-to-peer payment system that does not require a central authority. Transactions are verified by network nodes through cryptography and recorded in a public distributed ledger called a blockchain. The main features of Bitcoin include 1. Decentralization. The Bitcoin network is not controlled by any single entity or government, making it a decentralized digital currency. This decentralization is achieved through the use of blockchain technology, which distributes the transaction data across a global network of computers. 2. Limited supply. There is a cap on the total number of bitcoins that will ever exist, set at 21 million. This scarcity is built into the Bitcoin protocol to mimic the finite nature of precious metals like gold and to prevent inflation. 3. Anonymity and transparency. While all Bitcoin transactions are recorded on the blockchain and are public, the identities of the people involved in transactions are encrypted. While this offers a level of anonymity, it also provides transparency regarding the transaction history of Bitcoin. 4. Security. Bitcoin transactions are secured through cryptographic algorithms, making them highly resistant to fraud and theft. The decentralized nature of the blockchain also means that it is virtually impossible to hack or manipulate. The Bitcoin halving is an event that occurs approximately every 4 years, or after 210,000 blocks have been mined, and is a feature of Bitcoin's monetary policy. During this event, the reward that miners receive for adding new blocks to the Bitcoin blockchain is cut in half. When Bitcoin was first introduced, the mining reward was 50 Bitcoins per block. This reward halves every 210,000 blocks, so it was reduced to 25 Bitcoins, then 12.5 Bitcoins, and most recently to 6.25 Bitcoins per block in May 2020. The halving event has several key implications. 1. Reducing inflation rate. The halving decreases the rate at which new Bitcoins are created, thus lowering the available supply and slowing down inflation. This is a key difference from fiat currencies, where central banks can print money at will, potentially leading to high inflation. 2. Impact on miners. For miners, the halving means a reduction in potential earnings in terms of the number of Bitcoins received as a reward. However, if the price of Bitcoin increases, the value of the reward in fiat currency might still grow or remain profitable. 3. Market impact. Historically, the halving events have led to increased interest and speculation in Bitcoin, often resulting in a significant price increase leading up to and following the halving. However, markets are unpredictable, and past performance is not indicative of future results. The Bitcoin halving is a fundamental aspect of Bitcoin's economic model, designed to introduce digital scarcity to the asset. As the issuance of new coins slows down, the supply growth decreases, potentially leading to increased demand and higher prices if demand for Bitcoin continues to grow. This mechanism is part of what makes Bitcoin an interesting experiment in digital currency and economics.